Non-current liabilities and equity. In this chapter, we're going to look at the long-term funding side of the balance sheet. The accounting treatment of liabilities is far more straightforward than that of assets. We will identify the principal liability classes reported under non-current liabilities, where they come from and how they are accounted for. We'll also look at some of the equity accounts, look at what they are for and how they arise. So the session aims to learn about long-term funding side of the balance sheet, principal non-current liabilities, the equity accounts, what they are for and how they arise. Non-current liabilities are long-term obligations that are due for payment 12 or more months into the future. Companies with a current ratio greater than 1 must fund their operating assets with a mix of long-term borrowings, other non-current liabilities and equity. Very few companies fund their operating assets from equity alone. Most long-term borrowing is fixed rate and fixed term. Debt is senior to equity. What that means is that if the firm is put into administration and liquidated, the debt holders are paid their due before the equity holders receive anything. Debt holders do not share in any upside. Equity holders have the prospect of big capital gains in the event of the firm doing very well. The most that the debt holders can get is the contractual amount and the principal repayments and the interest payments. And once the principal is repaid and all the interest payments are made, the relationship ends. Equity is perpetual. Debt is has a fixed term. I introduced the idea of financial gearing when we looked at working capital and capital employed. If a firm is fully funded with equity, it has no financial gearing. As it takes on debt, its financial gearing increases. Potentially, financial gearing can increase the returns to equity holders, but only at the expense of higher risk. The firm is operating closer to its break-even point. However, interest on long-term borrowings, so interest on borrowings is tax deductible, and up to a certain level, finance theory suggests that adding debt to funding mix actually adds value to equity holder stakes, giving higher equity returns which are greater than the simple addition of the risk. However, if firms add too much debt, that increased leverage increases the bankruptcy risk. And as the gearing rises, so does the return lenders' demand on new debt, and that acts to constrain the amount of debt that firms can raise. Bank loans. Loans to corporations from banks have terms typically of 3 to 5 years. For small companies, these may be from individual banks, but for larger loans to larger corporations, banks will get together to make a group, a syndicate, in order for them to be able to make a loan large enough for the corporation to meet its needs, without any single one of them having too big a risk exposure in terms of a default. These loans may be fixed rate or they may be floating rate. In countries such as China, Japan, and Germany, and other developing, and in some developing countries, bank loans are an important source of funding for corporations, less so in the UK and the US. In the US and the UK, bonds are a more important source of financing for corporations than bank loans. These are bonds issued by the company. These are usually fixed rate with initial maturities typically of 3 to 8 years. If the company has convertible bonds, the value of the bond portion is reported within non-current liabilities, and the value of the convertible, the equity portion, is reported within equity. Net pension obligations. Introduce the idea of net pension assets. Net pension obligations appear when a firm has a deficit on its pension plan. So it only appears when firms with defined benefit pension plan has a deficit. It is the difference between the value of the plan's assets and the present value of the plan's obligations. So net pension obligations equals defined benefit obligations less market value of plant assets. You may also see deferred tax liabilities. These are taxes which are due for payment more than 12 months into the future, and these primarily arise from timing differences between what the firm estimated owes in tax from current transactions and how much it actually has to pay in the next 12 months. Equity. So our last account, and of course we've got the accounting equation. Equity is equal to assets less liabilities. Referred to the part which makes up equity are also known as stocks in the US and shares in the UK, and these represent ownership stakes in the firm. The ownership of a share in a firm entitles voting rights in most cases. The returns are variable. Equity holders are paid dividends. These dividends are not guaranteed. They may not be paid. They may go up. They may go down. Equity may be listed on a stock exchange, in which case it's a publicly listed company, and the shares traded. And equity is the most junior class. In the event of a liquidation, everybody else will be paid before the equity holders. And in most liquidations, the equity holders receive nothing. Let's have a look at some of the equity accounts. The two which confuse a lot of people are share capital and share premium. Together, these two accounts are used to record new money which has been invested into a firm. Share capital is also known as issued shares, ordinary shares, common stock, and called up share capital. Share of firm ownership and voting rights. The value in here comes from the number of shares that have been issued and a notional par value, which is usually a round number such as £1 in the UK or $1 in the US, but it can be 25 pence in the UK or 50 cents in the US. It's a notional amount. The value which is reported in the share capital account is equal to the total number of shares that have been issued times this notional value. It has no independent meaning other than that definitional value. The share premium account is also called capital in excess of par value. The value in this account is given by the value of equity issued less the amount recorded in share capital account. So share premium equals value of shares issued minus the value recorded in share capital. So the total of share capital and share premium has meaning. It is the total amount of new funds which have been invested in the firm, but the value which is in each one individually has no separate meaning. Let's look at an example of share capital and share premium accounts. So a German firm has an IPO of 2 million shares, each with a par value of €1. At the IPO, the shares are priced at €17.50, and the issue is fully subscribed. All that means is all of the shares have been issued and bought by investors. So total proceeds, 2 million shares at €17.50 each is, and I'm going to ignore costs, is €35 million. And the accounting of this, in share capital, we've got the number of shares issued, which is 2 million, times the par value, which is €1, so 2 million will be recorded there. And in the share premium, the total proceeds is 35 million, less the 2 million euros recorded in share capital. The value in share premium will be 33 million euros. The total owner's equity is the amount which has been raised, which is 35 million euros. Retained earnings, also known as reinvested earnings, and this is one of the most important sources of financing. This represents earnings that the firm has made for its owners and that have been retained in the business rather than being paid out as dividends. And so retained earnings is for a period, this is the changes equal to profit attributable to the owners minus dividends paid to the owners. Treasury shares. You may see this within the equity accounts. This will only be present if the firm has been buying its shares back in the market, and it represents this is a negative number. It represents the cost of own shares that the firm has bought back from the market, and this, in effect, this reduces the value for equity. Now, every firm says that they're buying it because the share price is undervalued. These shares may eventually be cancelled, in which case the number of shares issued will reduce, or they may be reissued, for example, to support an employee stock option plans, or they may be resold back to the market if the firm wants to get some cash. And then we get the portion of convertible equity component, which is the value of the option element of convertible bond split out. Technically, this is referred to as a bifurcation of the convertible bond. The vanilla bond part is reported within non-current liabilities. The equity component is reported within equity. And this is reported as, the name of it is the residual component within equity. So the equity residual component is equal to the fair value of the convertible bond minus the fair value of the liability, the vanilla bond itself. So that will be marked to market as the value of the convertible part and the bond change over time with interest rate. And lastly, preference shares. Preference shares, also known in the US as preferred stock, they are a form of debt that is senior only to equity. They pay dividends, but really these are interest payments. However, these payments are usually after tax. So they don't have the same advantages that debt normally has. And there are various forms: perpetual, cumulative, non-cumulative, which we won't get into. But the perpetual simply means that it has no maturity date. Cumulative means that if it misses any dividends, they are made up. And non-cumulative means that any dividends which are missed, the owners of preferred stock lose forever. And they have some equity characteristics. For example, some may have a mandatory conversion to equity under certain conditions. In the US, these are sometimes reported within equity, but they have a different set of owners, and really they should be reported as debt, and the dividends included from analytical purposes as debt, although, as already mentioned, they are normally not tax deductible. That's a very brief lesson. We've looked at long-term funding side of the balance sheet, principal non-current liabilities, where they come from and how they're accounted for, and a quick review of the equity accounts, what they are for and how they arise.